My name is Danny Robinson. I'm one of the regional sales directors here at Route Consultant, and I'm thrilled today to have a guest host, Leah Nelson, come in just a little while to talk to you about what's your route business worth. We're really going to be looking at this from mostly a FedEx perspective, but we are going to touch on some of our exciting new red route opportunities and what those businesses are currently valuing at, as well as the Amazon DSP space, which we're really happy to say that we're wading back into, and we're looking very much so forward to helping people buy those businesses coming up in the next year. But before any of that, everyone knows every week we have to go through it. So I'm going to get it out of the way now. Our disclaimer: Route Consultant is not endorsed by and is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, and is not associated with, nor has any connection whatsoever with Federal Express Corporation, FedEx Ground, or Amazon. So now that that's out of the way, before we dive into what Leah is going to come on and talk with us a little bit about, I want to go over a couple of upcoming events that we're really excited to talk about. The first of those are going to be our 2024 happy hours. We're really excited that we're going to try and get out to meet you guys about once a month across the country. You can check out in the chat box right now. We should have a link there for you guys to look and see what that schedule is like. Our first one's going to be coming up in late January in Atlanta, Georgia. If you're in Georgia, Tennessee, any of the surrounding states, please go to the website link that we just posted, get registered, RSVP for that. We've got all kinds of great stuff planned, a really fun venue in mind, and I can't wait to see you all there. Beyond that, make sure that you get ahead of the game and register now for the 2024 Contractor Party and Expo. We will be at the Gaylord in Dallas, Texas. And you know what they say about things being bigger in Texas? The same holds true for our expo. It's going to be the biggest and best one yet. So don't waste any time. Get registered for that. You can also go ahead and book your room at the block rates now. We typically run out of the first block sometime in the first quarter of the year of the expo, and then rates go up from there. So get it while the getting's good. Get in there and register for all that. And lastly, we've got a few new listings. We've got several new listings that we want to talk to you about. So I'm going to kind of go through these quickly. If you have questions about any of them at all, please reach out to us. info@routeconsultant.com. That's the best way to get a hold of us. Or if you're already working with a broker from the region I'm going to talk about, reach out to them, ask them for the details on that, and we'd be happy to get all that in front of you guys. So really quickly, out of Northern Indiana, 10 P&D routes priced at $1.1 million, running about an 18.8% EBITDA. There is one manager on staff, options to assume truck debt, and options for seller financing. And you guys who have been here and with us for a long time know that seller financing is something that I love more than anything else in this space. So jump on this opportunity in Northern Indiana. It's a really hot one. In Northern Texas, we've got 15 line haul runs priced at $3 million. Running right now about a 14% margin of EBITDA. That's made up of 6 dedicated solo runs, 7 unassigned team runs, and 2 unassigned solo runs. A really well put together breakdown of runs in that portfolio. There are 3 spare tractors. The dedicated runs offer reliable revenue. You guys know all the selling points. Reach out to us and talk to us about it if you're looking to get into line haul. This is an incredible opportunity to buy a sizable operation. We have a new bread route in Southern Georgia. One bread route priced at $145,000. That's about 33% of top line revenue annually. The business does about $8,300 in change a week in revenue and operationally services 11 weekly accounts. If you've been looking to get into some of those ancillary verticals that we've talked about, the bread space is a really exciting one. That sounds like a great opportunity. Reach out to us. We'd love to talk to you more. One of my new listings, 5 P&D routes in Northern Washington. This is actually Northern Seattle, a business priced at $550,000, running currently just under an 18% EBITDA margin. There is a manager on staff, 4 spare trucks, a very low mileage operation. We're talking less than 50 miles per route per day. Very low entry point to get your foot in the door with FedEx Ground and start growing the way that we love to see contractors grow. So hit me up about that one. Another bread route out of southeastern Wisconsin, one route at $160,000. That's about 48% of top line revenue. Does a little under $6,500 a week in revenue and services 5 weekly accounts. All right. Another Seattle listing. This one is on the south side of Seattle. 12 P&D routes priced at $1.6 million. That's about 93% of revenue. The business is running north of 20% EBITDA margins with a manager on staff, 13 spare trucks, SBA approved and pre-qualified and financeable. A very large roster of experienced drivers, a well-tenured manager, and the business is, like I said, already pre-approved for funding. So if you guys are looking to get into the space and are planning to use the SBA, hit me up. I'd love to talk to you more about this opportunity here. We have upstate South Carolina, 13 P&D routes, a little over $1.4 million, running 21% margins with 2 managers, 2 spare trucks, and a fleet that's comprised of much newer model vehicles. This is a great opportunity in the southeastern region. In northeastern Florida, we have another new bread route at $212,000. Does almost $13,000 a week in revenue. 1 truck available in addition to the business for an additional cost. And it operationally services 5 accounts every week. And then last but most certainly not least, we have 5 line haul runs out of Southern Connecticut, priced at $880,000. That's 78% of revenue, running about a 21.5% margin. 4 dedicated solo runs and 1 unassigned solo run. All the dedicated runs have really strong position at the terminal, and there's a very high owner salary that can be converted over into a manager salary to help with daily operations. So if any of those sound intriguing, like I said, reach out to us, info@routeconsultant.com. We'd love to talk to you a little bit more about all of them. But in the meantime, right before we bring Leah on to talk about what she's going to talk about, please keep in mind while she's going through her content, if you guys have questions, let's get those loaded up into the Q&A box at the bottom of your screen, not the chat function. If you put it in there, we won't see it. But if you put it in the Q&A, I'll be sure to get you in Q and we'll go from there. But with that being said, Leah, if you want to go ahead and come on, I know everyone's really excited to talk today. We're going to go over what your routes are worth. So without further ado, Miss Leah Nelson.
Hi, awesome. Thank you so much, Danny. Happy to be back on the webinars. Always a lot of fun, always a lot of good content, and love hearing all the questions. So any that you've got as we go through this, if Danny said, type them in the Q&A box and we'll go over those at the end. So perfect. Well, we'll just jump in today. Like Danny mentioned, today we're going to be chatting about valuations, from kind of a buyer perspective and a seller perspective. We'll focus on FedEx primarily, but we'll discuss a little bit about Bread and Amazon as well and how those are valued and current market trends for both of those. So to start, we'll take a look at the different valuation methods for each industry and where the market is currently sitting. As many of you know, pricing for FedEx is primarily measured with multiples and percentage of revenue. And for those of you that may not be familiar, the multiple is calculated by dividing the asking price by the net income. So in essence, this shows you how many years it would take to pay off the business if the cash flow levers were to remain exactly the same and you were to put every penny of the NOI towards paying off the business. So that's really what the multiple is designed to do. For the percentage of revenue, I would say this one is a little bit more self-explanatory. You calculate the percentage of revenue by dividing the price of the business by the annual revenue of the business. Percentage of revenue can be a really great way to compare businesses across different brokers. So if you're working, with Route Consultant and a different broker and maybe, 1 or 2 others, it can be a really great way to have an apples to apples comparison across the different companies. Revenue is really, really easy to measure and verify in FedEx. You've got weekly statements, you've got 1099s, all those types of things. So it's very easy to measure and very easy to verify. While NOI can have, I would say, a little bit of a level of interpretation to it if you're looking at projections or tax returns with add backs, things like that. So all that to say, revenue is going to be a really, really stable thing, really easy to verify. So percentage of revenue is a really good way to compare businesses that are being listed with different brokers or just, really just different businesses overall. It's a really apples to apples comparison. But looking at FedEx, so those are the 2 primary kind of valuation methods for FedEx. Looking at FedEx, I took a look at the listings, that have come live with Route Consultant in the last couple of months or so, and multiples are averaging around a 4.25 times for both P&D and line haul combined, and the percentage of revenue is around 75%. So that's where the market's currently sitting for FedEx. For P&D specifically, multiples are just a hair lower on average at around a 4.15 times, and the percentage of revenue is around 76%. So that's pretty stable. And then line haul looks a little bit different than P&D right now. Multiples are averaging around 4.45 times, and the percentage of revenue for those prices are around 70%. So keep in mind with those data there are generally fewer line haul operations on the market than P&D, so the sample size is a little bit smaller on that. Just the line haul market is just a little bit smaller overall. So Amazon pricing, we'll move into that next. Amazon pricing is also evaluated using multiples and percentage of revenue. kind of as Danny mentioned, there aren't many Amazon businesses on the market at the moment. We're really kind of opening those gates back up. So there's not a ton of data right now of businesses that are listed right now. But so looking at the average pricing can be a little bit tough. But looking at businesses that were listed in the past, some data that we've got from a while ago, Amazon businesses were valued at lower multiples and percentage of revenue than FedEx businesses, primarily because Amazon fleets are leased. So with many FedEx businesses, the trucks are owned. There's got some physical assets backing up the business, but with Amazon, most of the fleets are leased, primarily leased. So there are no owned physical assets to kind of back up the business, which can bring those multiples and those valuations down if you're comparing the two industries. But in the past, looking at that older data, Amazon listings averaged around a 2.7 times multiple and 40% of revenue. So again, there aren't very many Amazon businesses on the market currently. So we're going to continue to evaluate those pricing trends as more listings become available as we open those gates back up. So now on to bread routes. These are valued a little bit differently than both FedEx and Amazon. They are primarily valued using what's called a ratio. That's what we use for most businesses. You'll see that's what's listed on the market with other brokers. And if you're looking at bread routes directly, that's what we've got. So a ratio is the price of the business divided by the gross weekly revenue of the business. So ratios can vary pretty greatly. We've seen around 10-1 to 30-1, kind of in that range there, but the average sits around a 20-1 ratio. So that means the pricing of the business is 20 times the weekly gross revenue, not the net revenue, the gross revenue. So for example, a bread route, if it makes $10,000 in gross weekly revenue, and it was priced at a 20-1 ratio, that price would be $200,000. So that's how most people measure the pricing for bread routes. You can also look at bread routes as a percentage of revenue as well, same as Amazon and FedEx. That's a little less common, but something that does happen as well. And right now, the average for the percentage of revenue is around 40%. So that's the current market trends for all three of those industries right now. So if you have, a FedEx business, a bread business, Amazon business, whatever, make sure you aren't selling your business for just the value of the trucks. While that's your biggest physical asset, your contract has value to it as well. So make sure you're allocating a value to it. We hate to see people undervaluing their businesses and trying to sell them for just the value of the trucks when, in most cases, unless your business is just really tanking, you can get some value for the contract as well. So we're going to kind of go over some valuation factors, some things to look for, and some things to improve your valuation, whether you're planning on selling now or later or 3 years from now, or you're a buyer and you're just coming in. Here's some just kind of tips and tricks to get those valuations up. So with any business, whether it's FedEx, Amazon, bread, there are lots of factors that impact the valuation. So if you're planning to sell your business, like I said, at any point, whether it's now or 2 years from now, there are a couple of things you should really pretty consistently, constantly be monitoring to make sure your business is in top shape to sell really at any time. So first and foremost is going to be your NOI, your net income, margin, cash flow, EBITDA, whatever you want to refer to it as. This is the primary driving factor behind valuations. Of course, is how much money your business makes. Making sure your business is optimized and your NOI is really at full capacity will allow you to get a higher price when you do decide to sell your business. So I recommend tracking your NOI on a regular basis, whether it's weekly or monthly. Make sure you're keeping an eye on that. The more often, the better, to make sure that your NOI is strong and consistent. If your NOI is on the lower side or really just lower than you'd like it to be or lower than you maybe think it could be higher. There are ways that you can run your business more efficiently, whether it's with your route count or staffing or, whatever it may be. Maybe your fleet's not in the shape that it needs to be in. But if you aren't sure what's bringing down your NOI, you don't know what to do. Maybe you know what's bringing it down, but you're not really sure how to fix it, strategies to fix it. That is one thing that Route Consultant can help with. So we can help you with strategies on how to improve your business from an NOI perspective. Again, you want to make sure that you constantly have strong margins. Even if you plan to sell your business a couple of years from now, the longer record you've got of high margins, high consistent margins, the better off you'll be when you sell your business. Like I said, even if you're not planning on selling right now, make sure you keep an eye on that. Make sure you have really, clean records. And if you start to see those dips, if you're tracking your NOI, you start to see those dips, you start to see irregularities, make sure you get them back on track sooner than later. Because even if you, fix your business, if it's not doing so well and you want to, sell it and you improve your business right before you plan to sell it, it can be a little bit more challenging to convince a buyer of the improvements since you don't have like a history of long, strong margins. So On that same track, make sure that your NOI is not only optimized, it's high, it's doing good, but make sure that you're keeping clean records to clearly show the NOI. I would say this is a problem that we see pretty often. If you don't have updated and correct records, it can cause all kinds of problems through the selling process. Having messy records can be a big turnoff to buyers, and can make traditional financing a lot more complicated. So the SBA, conventional lenders, if you have those messy records, can make that process a little bit challenging, really, for everyone. And also, if your business, you've got messy records and your business can't be financed because of that, it does decrease your buyer pool of your business, because a lot of buyers are looking for that traditional financing. And if you can only accept a cash deal because your records are too messy, kind of a downside. So having clean P&Ls, balance sheets, tax returns, all those financial documents really is of the utmost importance. Don't mix too many personal expenses into your business. Make sure all your expenses are clearly labeled and they're accurate. Every expense is in the accurate place, in the accurate expense category it should be in, and make sure you know what all your line items are. Either you as a seller, you should know those, but make sure your accountant knows those too. Somebody's got to have the knowledge. But I've seen tax returns where half the expenses are lumped together and they're just called purchases. It's really vague, and it can make buyers ask, hey, what's this expense? And banks are like, hey, what's this expense? And if no one can tell you what it is, it can be make the process a lot more complicated. So like I said, having clean records on top of having your high NOI is going to be really, really important. So next, kind of things that can increase your valuation, taking care of your fleet. The better condition your fleet is in, the more you can sell your business for later on. This doesn't necessarily mean that you need the newest trucks on the road at all times. I know that's oftentimes not possible to have a completely brand new fleet, but having a nice, fully functioning fleet, make sure all your trucks are taken care of, that they get their maintenance done regularly. You've got records of that as well. And if you've got a few spares in there, that can be really helpful as well. This will improve your NOI overall, and therefore increase your valuation later on down the road. So as an owner, make sure your trucks are large enough for the routes as well. We see that pretty often where people are limited by the capacity of their trucks. Their trucks are full to the brim every single day, and they really can't optimize because their trucks are too small. So one of our biggest recommendations is have really the largest truck on the road that can fit on the physical roads you're driving down, and that can really increase your optimization. So another factor that really plays into the valuation is timeline to sell. And I think this is often underestimated when you're kind of looking at a valuation. But if you're a seller under some type of time constraint, maybe you have an OTC and FedEx is threatening to take away your routes, or you can't pay back your loans, or something's just going really wrong for you, that can really decrease your valuation if you decide to sell. Because if you need to sell quickly, generally you want to price your business lower so it sells more quickly as well. It can sell within that time frame that you're looking at. On the other hand, if you aren't under any type of time pressure, your business is doing well, you just want to, maybe you want to retire, just sell a piece off for some capital or what have you, you're not under any type of, time pressure. You can afford to price your business a little bit higher and wait a little bit longer for a higher offer. So that's why it's always important to be tracking your business financially and from an operational perspective. If you catch those problems early, you can fix them or list your business, before you have to at the last minute, and sell your business for the fraction of a price, at a fraction of like the price that it's actually worth. So, having no time constraints and making sure your business is really always in a condition to sell and you're not being pushed against the wall is really important. And again, if you think your business could be improved, whether it's doing really well, or maybe it's not doing quite so well, but you think there can be some improvements, or you just want a second set of eyes on your business, Route Consultant, we offer a ton of services where we coach you on how to make your business more efficient and more profitable. We can assist with consolidating your routes, optimizing DRO, pay incentives. Options are endless here on how we can help you, look at your business and make sure that it's running really at its peak capacity. We also offer, free valuations if you're a seller interested in selling. If you want to see where your business, currently stands right now from a valuation perspective. So, as you all know, everyone knows right now it is in peak, peak season is in full swing. It's December, Christmas is coming up. But Route Consultant, one thing to keep in mind, if you do want to get a valuation right now or anytime in the near future, Route Consultant does not include an allocation for peak season or growth in our valuations. We do tend to kind of err on the conservative side of that, leave a little bit of room for error. So we don't include peak season, because once you include peak season revenue, you also have to include peak expenses and things, all those things, which can be kind of complicated to calculate. But all that to say, we don't include peak season revenue in our valuations. So if you have a valuation done right now, we do use data from September and October to keep that, keep peak season out of it prior to when peak season, really ramps up. So we'll continue to use September, October data, through December, January, and then around, February or so, we'll have data from the new year to look at and really use that data for valuations. I know January can be a little bit of a slow month, so if we need to, we can also look at September, October, kind of going into the new year and compare the two. So just like to give that warning when we're doing, not even a warning, but piece of information when we're doing valuation. So all this said, all the things I spoke about above, it really sounds like it's more geared towards current owners, people looking to sell, which it kind of is, but buyers can, really take heed of this advice as well. If you're looking to purchase a business, starting off with these really good habits, having those clean records, having good trucks, and having all that really, solidified and a plan for that from the outset. You've got good habits and good infrastructure of your business. It'll help you run a better business overall. And then when you eventually do decide to sell, you'll be prepared. You'll have a really long history, complete, clear, strong history of the business with good records and just a fully functioning, really well-run business. So if you're a buyer who closes on a business as well, we're always here to assist you through your first few months of operation, help you optimize the business that you acquired. So all those services, that we offer to sellers, we can offer to new buyers as well. Take a look at the business you've got going on and really help you improve it. So that's what I've got for today. Danny?
Excellent. I loved it. It was really well done, Leah. Thank you for doing that. So folks, now is the time where it's good for you to click on the Q&A box, start loading your questions up into that. We'll take an honest look at those. We'll start asking Leah, and her and I will dive in and start answering some of those questions. Leah, there was a couple that came in while you were talking. So I just wanted to kind of touch on one real quick. The multiples that you gave as route consultants averages earlier in your presentation, are those based off of sales price or list price?
So those are based on listing prices. Like I said, businesses that have been listed in the last couple of months. As far as sale prices go, I haven't looked at the average from the last couple of months, but I did an analysis fairly recently. Normally, businesses sell at around 90% of their listing price. So if your business was listed at around $1 million, it would, you would likely sell it for around $900,000. So that's a stat that you can use there. As far as the multiples go, I'd have to do a little bit more calculation on that, but that's a benchmark that we could use.
That makes perfect sense. Yeah, and I know that from the deal board that I'm working myself right now, the listings that I have, that mid to high 3 range has kind of been the average of where we're listing them, and they close right in that same range as well. It's not a huge precipitous drop off there. There was a question as well from Campano saying that most businesses are sold around a 3.5 multiple, and he alludes that some of Route Consultants listings seem to be listed higher than that. And I will say, Tom, that yes, our listing methodology is a little bit more conservative than some. And we also broker all of the deals with the assumption that the vehicles are going to be coming free and clear with title in hand to the buyer, which sort of offers us the opportunity to achieve a little bit higher multiple than the national average. But we've actually seen our listing multiples sort of go from the low 4 range to the high 3 range. And that seems to be where things are cash flowing right now when it comes to bank valuations, because along with an average lowering in the multiple of EBITDA that we're listing and selling businesses for, we've also seen a precipitous rise in interest rates, which is greatly, we can't have one without the other. So as bank finance deals become more expensive on the debt service side, and we're looking at cash flow analysis to get those deals banked to start with, it sort of necessitated a little bit of a normalization in the listing multiple. But good news on that front, just a few hours ago, the Fed did meet, and we have not had any interest rate hikes today. They are holding firm, and it seems like all signs really point to some potential rate drops early next year, which are just going to do a lot for these listing valuations and what we can do on the financing side on those. Sorry, I didn't mean to ramble. Let's move on to the next one here. What is the breakdown of cost for a rural route as far as gas, payroll, et cetera is concerned? Maybe an opportunity to talk about how each CSA has metrics built into their comp structures there, Leah. What do you think?
Yeah, absolutely. So the cost for rural routes, of course, fuel is going to be higher than with those urban routes. It's hard to give an exact percentage on fuel because it can vary really so greatly depending on the trucks that you've got, the size of the trucks, and really, rural routes encapsulate a really large mileage band. So I won't give an exact percentage on that, but you are going to see higher fuel costs on your rural routes. You generally do see lower payroll costs, though, as a percentage of revenue on your rural routes than your urban routes, in my experience, because you really, in urban routes, because you don't have as much repair and maintenance costs, you don't have as much fuel costs, you can afford to put a little bit more into payroll than with those rural routes. So you're going to see your payroll costs a little bit lower for rural. But yeah, kind of like Danny mentioned, the contracts are for FedEx, the FedEx contracts, the rates that you get. I would say the primary kind of factor there is whether it's rural or urban and how many miles it does. And so, really either way, whether you have an urban route or a rural route, if FedEx is doing its job properly, which in a lot of cases it does, you should be able to have the same amount of profitability on a rural route as you would an urban route, regardless of those higher expenses for urban or rural routes.
Right. That's why it's always important to talk to us come negotiation time. When you're presented your MESAs, we can absolutely help you wade through that, kind of take a look at the unique characteristics of your specific CSA, what your expenses are going to look like, and how you can help, FedEx find a medium ground there to balance that all out. Brett Lee asks, for FedEx P&D, the fleets I see vary greatly in terms of quality, age, value, etc. What percentage of revenue do routes sell for without including the fleet in the sale?
Yep, and I've got data on this. It was going to take me a while to pull it up. I don't know it off the top of my head because it does depend on the NOI still. Is again always going to be that driving factor there. I know businesses with NOI, very low NOIs, like very, very low, like distressed businesses, are around like 10 to 15% of the annual revenue is what we assign to the contract. It is quite a bit higher for businesses that are making a fair amount of money. I would say if I had to pull it off the top of my head, 40 to 50% of annual revenue would be allocated as the price of the contract. I don't hold me to that completely, but I can definitely pull that data and send it over at some point.
Yeah, we'll be happy to. You can reach out to us, info@routeconsultant.com. We'll get back to you with that. I will just add to that it's very seldom that we actually broker these contracts without the fleet being included. There may seem to be some nuance to that where people are like, well, maybe I can get a better deal for the routes without the fleet. When you really take into account the costs and the capital that you're going to have to invest to get a fleet of your own to bring in, the offset that you're going to see in the dip in what your maintenance cost may be or your fuel consumption might be really doesn't offset the capital expenditure for investing in an entirely new fleet. And then if you wanted to maybe go the other route where you didn't take the fleet and you invested in a leased vehicle program, obviously we'd love to help you with that at Hello Truck Lease. We've got great opportunities for you there, but still you're going to have to run those lease expenses through our projections added to the expenses, and it's going to greatly affect the way that NOI plays out for you. That being said, the reason that we value the businesses with the assumption of the vehicles coming with it is because we know that in an asset purchase agreement, which is exactly what we do the majority of these deals through, having the physical assets, the equipment, and the contract combined give you the freedom to set up your business, your corporation, build the efficiencies into that you need to, and take the appropriate depreciation schedules. If you were with us last week, we talked a lot about that in the tax strategy session that we had, but having a sale with vehicles not included is a rarity around here. It probably makes up less than 3% of our deals, I would say. So with that, on to that, Ed Burke asks on the same topic here, if the fleet is included in RC's valuations and sales, how would the value of the fleet impact the valuation? And I will tell you, it doesn't really. But Leah, do you want to kind of expand on that and how we lean on the net operating?
Yeah, that's exactly what I was going to say. So if you've got one of the newer fleets, a higher value fleet, it's equipped with all the right technology and you've got better trucks in place, you're going to have lower repair and maintenance costs, and then you're going to have a higher NOI. You probably have lower fuel costs as well. So you have lower fuel costs, you have lower repair and maintenance costs, and therefore you'll have a higher NOI. And that's really how you land on that higher valuation. So we don't necessarily look at the trucks themselves, the fleet, and we're like, oh, this is a really high value fleet. We notice because of the high value fleet, the NOI is higher, and then we value it based on that.
Yeah, I couldn't agree more. There's a little bit that can be said about, a brand new fleet offers you the opportunity to maybe get just a couple of a tenth of a point, maybe higher on the listing multiple. But it's going to lead you also to a scenario where you have a little bit more flexibility and creativity with deal structure, because there's going to be debt attached to that can be assumed. And that really affects things. If we're not having to deal with bank financing, and we can have a cash and debt assumption deal combined where you're all out with no debt attached to your name as a seller, it can maybe affect the price as far as you cutting somebody a deal for ease of transaction purposes there. So there's a lot of levers that get pulled when we start making decisions like that. Steve Gentile asks, do you think routes that run 5 days a week should have a higher value?
I think my question is, are there any routes that are 5 days a week anymore? I haven't seen that in a really long time.
There's only a couple that I know of, and normally those are terminals that haven't integrated with Postmart, right? So it's just ground delivery. There's no home delivery integration or no real e-commerce delivery there. I will say that when it comes down to it, we don't really value a business that runs 6 days a week now higher, but think of it from a numbers perspective, if you would, for a second there, Mr. Gentile. One less day of operational expenses with no loss of revenue is going to do good things for your bottom line, right? And if we're always pricing these based off of the net operating income, then that's going to obviously be a big benefit to you in the way that we list that. Apparently Stephen Gentile is a current contractor because he's saying his terminal does 5 days a week. I would be curious if you had e-commerce deliveries, or if you were 100% ground. There's like one terminal in Los Angeles that I know is like ground only. That's the only one I can think of. Steve, email me, daniel.robinson@routeconsultant.com. I've got questions. I'm curious about them. But moving on to the next question, Daryl Kelly asks, given that a buyer gets an SBA loan and assuming that the rate decreases a quarter point in a given month, how long before you see that decrease on your loan? I can tell you, Daryl, and you may know something a little bit differently, but our preferred SBA lender, GBank, their policy is that they're going to adjust the rates on your loan quarterly. So if in Q1 we see a couple of points drop, they'll take that into account for your Q2 loan repayments. Okay. On down the line, Matthew Million, which is just a great name. If you already have optimized your routes, how would you create more value to drive the multiple higher upon selling? Great question, with the nuance that we're not going to drive the multiple higher, we're going to drive your net operating income higher, and the multiple is going to net a higher sale price. What do you think, Leah?
Yeah, I mean, I would agree with that. If you've already optimized your routes, I mean, there's always ways that you can improve your NOI. If you're running as slim as you can on routes, I'm sure there's other things you can do with pay structures, or there's savings you can have in fuel by using a different fuel card, or different repair and maintenance strategies. There's always a way that you can really increase your NOI, even if your routes are already optimized. Yeah, I couldn't agree more. Finding ways to marginally win there. Reach out to us. We'll get you connected with the Route Consultant Purchasing Alliance people. There's great ways to save marginally on a number of your expense line items with your operation through that, plus the opportunity to get a $10,000 rebate check every year. That's always a good thing to have. So Ed Burke, love you, man. He says, what percent of deals have seller financing, and what is the average percent that the seller will finance? This is a great question. I love it. Leah, I know you keep accurate tabs on these things. What say you? I do, yes. So percentage of deals that have seller financing, I would say at least 50%, probably more than that, up to 60, 70%. We do coach our sellers on seller financing. It can be a really great tool for both the buyer and the seller. Because as a seller, you get to collect interest on that seller financing. And as a buyer, you'd normally get lower interest rates on seller financing than you do with traditional financing. So tons of advantages to seller financing. We do try to coach all of our people on that. I would say anywhere, kind of depending on the time of year, between 50 and 70% of our deals close with seller financing. As far as average amounts go, 10% is going to be kind of your standard amount there. And then, we've seen deals go up as high as 90%. That's not normal. Don't bank on that, but 10 to 20% is going to be fairly standard.
Yeah, I've had a couple of those 90% seller finance deals. Those things are sweet. We get them done quick. Kenneth Baird has a great question. What do you see as the average P&D NOI? And I think that the percentage of revenue, the margin is probably what we're going to go off of there, not a dollar amount, but percentage. Right. I know in my region, I'm seeing an average of anywhere from about 8 to 15%. What are you seeing nationally? I'm hyper-focused on my region. Yeah. Sure. What are you seeing, Leah? I
would say that's not too far off. I think the average right now, the most recent analysis I did was around 16%. It's been holding steady at an average across line haul and P&D, the whole shebang, at around 16% for a while now. Of course, that can be lower or higher. It is an average. So I would say, 8% is probably the low end. 20 to 25% for really good P&Ds and some line haul businesses is going to be on the high end. The average is around 16.
Perfect. I love that. Anonymous attendee always here on seller financing. What interest rate do you see that going at? Similar to the SBA, Heck no, Mr. Anonymous attendee. My average rate when I structure these things is about 6%. What are you seeing, Leah? Anything different than that?
Yeah, I was going to say 5 to 7 is the rate I was going to say there. So 5 to 7%, way lower than the SBA.
That's right. Yeah, the buyer saves money, the seller makes more. Seller financing is the way to win in this space, people. You heard it here first. Tim Yarborough, average expense load to bread routes? Question mark. I don't know anything about bread routes. That's not my area of expertise. Leah, what do you have to say there?
Yeah, so I will say we're still evaluating really those kind of NOI trends on bread routes. So I don't want to give any solid data on that yet. You know, we're I don't want to say, you know, we've been doing research on it for a while, but NOI is one of those things that we're finding is a little bit harder to get on bread routes. So I will have more data on that in the coming months.
Spoken like a true pro. Eric Caltabiano says, I have a person inside my P&D terminal that's looking to sell off his line haul. What is the best way to evaluate the routes that he's offering? Eric, the best way is to call me. We'll get it taken care of for you, man. And I'll even get you hooked up with a referral fee if we sell his business, because that's the kind of company we are. Hit us up. You can feel free to give him our info. Info@routeconsultant.com is the best way to get a hold of us. We'd be more than happy. We have line haul experts for those larger contracts, and our regional directors are more than capable of handling the average size line haul load. So reach out to us. We'd love to help anyone that we can in that space. With that being said, last call for questions. Is there any final thoughts that you had on valuations? Anything you really wanted to add in before we call it quits here, Leah?
Me? No. I would say, just like Danny said, you know, if you have, you know, questions about your valuations on your business specifically, whether you're a buyer, you know, looking at a business, or a seller who owns a business, give us a ring. You know, we've got Danny, we've got a whole team here. We've got a whole team of analysts, which is really kind of my bread and butter, to take a look at those businesses and see the value of them.
All right. Thank you so much for being here with us today, Leah. Your expert testimony was the best. For everyone else that was with us, thank you so much for coming back to the webinar. We'll see you next Wednesday. Really looking forward to it. And until then, stay blessed.